Hi, I'm Mike Cintolo, Chief Analyst of Cabot Growth Investor and Cabot Top 10 Trader. I'm here with your Cabot Weekly Review, and I am recording this late Friday morning on November 18th as well. And just as a heads up, I will be doing a quick video next Wednesday. Obviously, our offices will be closed next Friday. As for right now, yeah, this week's been pretty flat with the major indexes, which is totally fine after the nice stabilization, I guess I'd say, from late September, early October, even as all the sacred cows were getting hit. And then, of course, the inflation report last week kind of kicked things into gear, causing an intermediate term green light from our trend following indicator, which is obviously a step in the right direction, a couple of steps in the right direction. To be fair, other top-down evidence is still mixed. I mean, the longer-term trend is still down, not that you'd be expected to turn right away. The broad market is improving, but not quite enough to say the sellers have really left the building. But overall, like I said, a couple of steps in the right direction. The biggest thing, which I've mentioned probably every other video this whole year, is that we're still seeing a decent amount, a lot of selling on strength, especially among growth stocks, but really elsewhere. Whether it's all-time highs or multi-month highs, it definitely doesn't feel like the Fidelities and T. Rowe Prices are saying, oh man, we got to buy 1 million shares each of these 8 stocks. It's more like, well, maybe we'll nibble on dips. We'll try to build some positions over time, but you don't get the feeling that it's really off to the races at all. And the title of this week's Growth Investor was just that. It was no rush. At least with growth stocks, it's, there seems to be more air pockets and accidents, so to speak, than things that are really just taking off on the upside. There are some things working. And the good news is all this is more descriptive than predictive. If the market can hang in there, and it has done a nice job of shrugging off like the latest, all this crypto mess that's going on, which is probably going to cause some issues with some hedge funds that have to sell other stuff to meet margin calls. All that's going on. The market is holding up fairly well. The Fed was relatively hawkish this week. Some of the speakers still hold up pretty well. So the longer it can do that and push higher, the greater the chance that some of these stocks that are kind of stagnating, unable to get going, will start to break out and confidence will increase. But as always, you kind of have to see it to believe it first. Right now, like I said, at least on the growth side of things, there's no rush. I will talk about some other sectors that are a little bit more in some solid uptrends here in a second. In Cabot Growth Investors model portfolio, we tiptoed into the market last week, but then kind of sort of par for the course here. One of the stocks we already owned kind of sprung a leak. We had to sell that. So we're still 80% in cash. I'm not opposed to doing a little bit more buying. In fact, I would say if the market holds up, that's more likely than not. But my main message is, before I put it another 30 or 40 or 50% to work in the portfolio, we're going to need to see some of these stocks really get going on the upside and continue to get going and follow through, as opposed to up for 2 days and then smacked right back down. Okay, let's hop into the charts. As usual, I am using MarketSmith. It's a product of Investors Business Daily. Good product. Should check it out at marketsmith.com. So here's the NASDAQ. Couple of things. Here's that sort of bottoming action from, I don't want to say bottoming action, but the late September low was kind of the low for a lot of these things. This actually ultimate low so far was actually a bad inflation report, and the market turned around on it, which was like an initial clue. And here we are, above the 25-day moving average, this green line, and the line is rising. So that's an intermediate term uptrend by our measures. Now the NASDAQ, though, is the weakest index. The other ones we follow are looking better. And I mentioned this before. Here's the S&P 500. You can just see just more daylight close to the 200-day line, which is this black line. And then you start digging into things like small caps, which are actually toying with the 200-day line here in recent days. Yes, they're hitting some selling, but overall, holding pretty well here. Mid cap, same sort of picture. Okay, so overall, green light on the intermediate term front, longer term trends still down. Some of the other top-down evidence, not quite as much. The one thing, the top-down, that does worry me is, again, this is XLP. So this is consumer staples, which to me is the ultimate defensive sector. And you can just see this looks much better than really almost any other index, especially the NASDAQ, but even some of the other ones. That's not ideal. But even among the major indexes, when you look at the Dow Industrials, and to be fair, there are some pretty good looking industrial stocks, but this thing is almost back to where it was at the August. This was the August market peak before the Fed said no thank you, and the market tanked again. So that's already there. It's well above the 200-day line, and with the Dow leading, it's not a death knell. It's not like bearish. It's just not usually how markets bottom. Now, I'm open to anything. Usually you get a little bit more risk on trade, but again, more descriptive than predictive. I don't think there's any doubt that you're seeing more either defensive stocks or defensive growth. I mean, like today you have stuff like a Ross Stores, which is sort of a defensive retailer, popping on earnings, TJ Maxx, those sorts of things. You have names like a Gilead, which is, don't get me wrong, we had this in top 10, it looks good. But, it's not like a growth stock. You can see earnings estimates are coming down a little bit. But it's cheap, it pays a dividend, it had good earnings, they beat estimates, and you can see what the stock's done here recently. There's just a lot more of that stuff is in favor, kind of like people have to put money to work, as opposed to like, okay, what are the real leading stocks of the next bull move? So again, doesn't mean that's going to be the case. These things could chill out here, and maybe I come back next week and say, hey, we are in a rush to buy because everything is starting to break out. I'm all for it. We just kind of have to see it to believe it, okay? Just going through, I just wanted to point out, sort of on that theme, if you look at some of this is the IPO fund, which is, they own a bunch of recent IPOs, when I say recent, the last couple of years. And it's one of the growth funds and indexes, I kind of keep an eye on most days. And you guys see it's really nothing doing here. It's not even an intermediate term uptrend. It's still really testing the lows from back in the spring. The ARK fund, again, this is sort of the center of the eye of the hurricane, so to speak, in terms of growth, but not looking too good. And even if you look at stuff like, here's the Russell 2000 growth, IWO, it does look better, but it's certainly not as strong as the Dow, which would be up here. The equivalent would be up here. So just something to keep in mind, that there's still, up is good. That's my motto. So I'm all for it, but it's certainly not, I don't think it takes a genius to look at a few stocks and say, okay, what's really working here, number one? And a lot of stocks are still hitting resistance, number two. Just as an example of that, I'm going to get in, sort of do this and get into the sort of the watch list, but this is Academy Sports, and I've mentioned this. It's just very, it looks good. It's on my watch list. I do like it. And you look, I've mentioned this before on the weekly chart. This is some big picture base. And actually this latest structure in here, I like a lot in terms of it's not so much tightness, but just kind of kept trying to bang low where it couldn't. And now it's sort of releasing on the upside. So the weekly chart looks good. But just to give you an idea of what's going on, this was, I guess Tuesday, it almost hit 50. Then Target reported earnings. The stock goes down to 44. And now it's back up to nearly 50 2 days later. I do like, we are starting to see a little bit of, as opposed to sort of, test, fail, we are starting to see a little bit of like test, pull back, but not, might pull back here, and then tests again and pulls back here, and then tests again and pulls. So we're seeing a little bit of tightening very early on that, but it's just still very, very choppy. Now, with that said, I like Academy ASO. It's on my watch list. I do think, whether you want to try to buy a breakout or nibble here with a stop, it's tough to kind of get your arms around. Ideally, what you'll see is some of these things, this is the ideal situation, is this thing breaks out and runs whatever, a decent amount, and then pulls back, a few points and chills out for a bit and kind of offers kind of a more proper entry. But that is one to watch. Another one that I like a lot is Shift 4. But again, you're seeing this sort of, it had this big shakeout on earnings, 2 weeks ago. You can see here's the earnings day. It gapped up, it closed down. Oh, this thing's toast. I pretty much deleted it from my watch list. I come back a few days later. Hey, what's Shift 4 doing? 6 days in a row of huge volume, right back to new multi-month highs. Now, again, it hit new highs. What did it do? It went from 54 to 46 here in 2 days, 2.5 days. So you're just dealing with a lot of that chop. But keep your eye on it. Let's see if this thing can hold up here again, and then maybe make another run at it next week or two. It could still be overall proper. And if you look at the weekly chart, which tends to filter out a lot of the noise, this was a big clue last week on earnings. That was support. This week, not as good. That's kind of distribution. But, if it can kind of hang in here and resume higher, that is one I like. Let's see, running through stocks. So outside of growth, oil service. So there's some oil explorers. I mentioned that before. They're a little later stage. Oil service, I still think looks really good. So NOV is one. And right here, I know oil's down like 5% today. I'm not an oil expert. But just looking at some of these charts, it looks to me, just if you didn't know anything about the world, you have this incredible, look at all this volume down here, thrust, big earnings, big estimates, easy for me to say. And now it pulls back a couple of points. Could it keep pulling back in here? The 50 days way down here at 19.5. Sure, it could. But, you're starting to get to the point where you're like, well, it's kind of near its old highs. If you look at the weekly chart, kind of near its old highs over here. Could there be support in this area? That looks pretty good. Schlumberger, I still think is probably, the liquid leader. Same sort of pattern, huge volume expansion, big earnings, big estimates. Obviously, it's got a lot of sponsorship down to the 25-day line here. I'm not saying it can't go lower. It could. It could easily just kind of kite lower. Maybe oil tanks next week. I have no idea. But so far, it looks like a proper, relatively low volume pullback. We'll see how it goes. Financial stocks, not my cup of tea, but a couple of things to show you. Let me just start. Here's XLF, which is kind of your, all-around financial index above the 200-day line and holding here. This is kind of what you like to see. Has a big run. Yeah, it pulled back the last few days, but, it's holding in there. It's not just up and then, the balloon pops sort of thing. So far, so good. The other thing that's interesting is this is the broker-dealer index. Now, I'll be honest, I don't exactly know what's in there anymore, but you can just see the relative performance line on the weekly chart. Again, it's actually it's above its August high on this weekly chart. And somebody I read online said it was at high relative to the market. It's at its highest level now in 10 or 15 years, something like that. So that's kind of interesting. And if you do go through some stocks, like here's Goldman Sachs, which I do keep an eye on just as sort of kind of a granddaddy bull market stock, so to speak. This is not nothing right here. Okay. It doesn't mean, this was a good move too and it failed. Don't get me wrong. But clearly above the August high, higher low. That's kind of the definition of an uptrend, I guess, if you want to say that. Good volume down here. I'm not going to get into the numbers and the valuation, but, it's only 8% off. It's 52-week high. I mean, down here on the weekly chart, you can see 3 weeks of big volume. So that's kind of interesting. JP Morgan, again, this isn't really my cup of tea, but, obviously a bear move down here. I like the shakeout below this low. You can see kind of the summer spring low, and then it shook out here recently, and then boom, like right off the bottom, huge volume on the buy side and a persistent advance. I do like how the weekly charts filter this out. If you're kind of into this sort of thing, I wouldn't do this with a financial stock, but this is a little bit of double skyscrapers. We'll see what happens. I wouldn't go too far with that, but that looks pretty good. Stifel Financial is another. You could go down the line. This one's a little bit more of a bull market stock. But again, you just kind of see this huge buying at the lows and kind of hold. And that's just, this volume at the lows is great. It doesn't prove anything. You also need price. And so far, these things are kind of holding the 200-day line, holding above or at or above their summer lows. So anyway, financial stocks are interesting. And I would just say as a big picture thing, that is kind of a feather in the bull's cap to me. Not that I'm going to go buy them, but the longer they're acting well, the longer the market can act well, and the longer some of these other stocks that are a little bit riskier can start to kick into gear. Okay, just going through the rest of my names here. This is I've mentioned housing. This is DR Horton. Yes, you're not, it's not growth or whatever, but higher low above the 200-day line. Good reaction to earnings. They're already pricing in. A big decline in earnings next year, but it's still supposed to make $10 a share. Who knows, with the housing market, but it's not like Wall Street's expecting things to be great. They think earnings are going to fall 40%, but the stock has been resisting. It's cheap, yada, 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 acting well. I would say there's not, there's some others that don't look as good, like Toll is below the 200-day line. Pulte is kind of playing with it. So DHI, I think, looks the best. It's a little bit of a lone ranger here, but that is something that's kind of a name to keep an eye on. Some of the solar still look good. So ENPH, now this one's kind of, again, it's right back into resistance here. I like it. I think it can move higher, but again, it's going to come down to the market. It certainly looks like it wants to go higher, but this area, give or take 5 or 10 points, it's a volatile stock, is going to be key. SHLS, SHLS, this is interesting. It's kind of a secondary solar name. I won't get into the story, but great sales numbers. Earnings turned around this quarter. Big estimates. Growing sponsorship. 500 funds. That's not bad at all. And obviously, it had a big earnings gap this week. Again, you're dealing with stocks that it's liquid. Don't get me wrong, or liquid enough for me. But the stock, the range of the past, even recent days before earnings, the range is like, a couple of points a day on a $30 stock. So the volatility is pretty big, but there's no question this power is something that catches my eye. So SHLS, SHLS is one to keep an eye on. Elsewhere in retail, I mentioned some of the defensive retail, but Lululemon is kind of interesting. It's an obvious name and all that. But again, I kind of look for some of these stocks that kind of been bottoming out here really for better part of a year. This is relative to the market. You can just see it's kind of been bottoming out and now it's been ticking higher. Did find some buying recently, so LULU, just something to keep an eye on. Neurocrene, I've mentioned this in the biotech space. I think last time I mentioned it, I said, it's up here. Look for a pullback. I would say the volume on the pullback isn't ideal, but at the end of the day, it held its 50-day line and it is bouncing pretty well. So let's see how it goes. But NBIX certainly looks like a leader there, real sales and real earnings growth. Chip stocks remain very, very hit and miss. But Global Foundries, which we've kind of been watching since it came public, it looked like it got going earlier this year. No. Tried to get going here with a few weeks up in a row. No. But now it's kind of formed this base, and you could call this a nice breakout on earnings last week. And I think they beat estimates and stuff like that. So we'll see how it goes. And then still watching on semiconductor. This stock was at 77 a few days ago, and then fell to 68, and now it's back to 72 as I record this. So it's all over the place. So it's hard to kind of pin down. You'd like to see these things tighten up, which in and of itself is a sign institutions are active. They don't let these things flop around if they're really active. But with that said, it is a nice base on base. You wouldn't know the market's had this huge bear market in here. The volume patterns are okay. And let's just see. I mean, all I can say is the stock is 6% off all-time highs after the NASDAQ got destroyed. So that's pretty good. And obviously it's reacting well during this latest rally. And then last couple here, this is more on the industrial side. So this is Pacar, which is more of like a commercial truck, like heavy duty parts and stuff like that. But XLI, let me just show you, sorry to go in 100 different directions here. This is XLI, which is sort of the ETF. And XLI and XLF, the financials and industrials, they do look good. This looks a lot like the Dow Industrials, not surprisingly. And there's a few examples, but here's like Pacar, and just looks very persistent. It's not, earnings are supposed to shrink this year. It's not my cup of tea, but you have to respect the action. It's good to see. My guess is, the first pullback will probably be decent if the economy's in good shape. Back on the energy side of things, I mentioned how producers are kind of tricky, but Chesapeake Energy, natural gas could be stabilizing, and this stock has basically just kind of been hanging out, which I think is a good thing. It is a little bit of a lone ranger, meaning the other natural gas stocks not as good. But you just kind of keep an eye on it, and if it fails, it fails, or you nibble and it fails, whatever. But if for whatever reason, boom, something happens in the world and the stock gets going, it is a pretty decent pattern there. And then last but not least, this is really what we're looking for. So I've mentioned these stocks before, but this is Dexcom. The stock went, big picture, you can see it's gone through the ringer, had a rally, this and that. And then last month, let me just do the daily chart, not get too cute here. Last month, it basically went from 80 to 120 round numbers. Okay, so it had a huge move. This was a Medicare decision. This was earnings. And since then, it's just calmed down. Again, could the stock just tank? It could, but so far, this is kind of what you want to see is, hey, now it's kind of coming under control. And if it can, boom, all of a sudden you're like, whoa, this looks pretty good. And maybe it chills out for another few weeks. Insulet, which is in the same group, it actually uses Dexcom's technology, the insulin pump. But same sort of thing. You go from 210 to 320 in the blink of an eye, and on the weekly chart, it's near all-time highs. Actually a little bit stronger than Dexcom. And so far, it's just been kind of chilling out. It could easily chill out for longer. It could come in, whatever. But so far, that's the type of proper action looking for. And if we saw that among, 24 stocks that had, big moves up and then they kind of tighten up, that would be a good sign, I think, for the market, or at least a potential in terms of really getting more heavily invested, okay? As it stands now, though, I still think, at least with growth, it's not a big rush. You don't want to ignore what's going on. I wouldn't never ignore the evidence and just say, oh, this rally's going to fail. You don't want to say that. It could, but it could be the real deal, So you want to follow along, but at the same time, you're not buying, well, you could, but we're not just buying like the NASDAQ or whatever. We're buying individual stocks. And on that front, unless you're, totally trading the off the bottom stuff and some of these things, and it's more of a trader's market, it's more up and down, it's more rotational to this point. So I think right now it's just, you just take it day by day. Right now, this second, some encouraging top-down evidence, some stocks looking good, put a few toes in the water, see how it goes. But in terms of, really flooring the accelerator, we're going to want to see the market and some of these stocks really start popping out to new highs, where you get the feeling that, okay, the turn has come and now everyone's piling into these leaders. Okay, that's all the time I have for today. As always, thanks for listening, and be sure to come by again next Wednesday for another Cabot Weekly Review.